now a very important topic presented by Jay Marathe of Cartagena Capital, and he's talking about exits. Great.
Thank you.
Welcome to Ecosummit.
Thank you. Okay, so let's talk about taking a company from fundraising through to successful exit. I'm Jay Marathe, a partner at Cartagena Capital. We help European technology-driven companies, growth firms, to raise money from investors or to seek buyers in a trade sale, M&A. So we're corporate finance advisors. And although we work with European companies, we take companies globally to investors and buyers. Having the presence on the ground is really important for us, not only across Europe, but in China, in Japan, in the US, senior-level people with access to the right buyers, speaking local languages, Chinese, Japanese, and American. Just a bit about my background. I've worked a fair amount in venture capital, a little bit with Durlacher during the internet boom from 1999 onwards. Did some advisory work for Atlas Venture, and then worked in Allo Private Equity in the clean tech space. Areas of expertise, well, you can't call it clean tech anymore, so smart industry or resource efficiency, energy technologies, but also new materials, production processes, and so on. And I have a background in technology, media, and telecoms, and the border between TMT and energy is a very hot space right now for investors. Previously, I was head of smart energy at British Telecom, designing and implementing a system to manage energy across 6,000 buildings, including data centers, offices, and the telecom network. And I've been to a few good parties at a few good universities. Let's take a look at what's happening in the marketplace. So there's been a steady decline in the level of clean tech activity, fundraising and M&A, since about late 2010, early 2011. It's been a difficult exit environment, global economies slowing down, not a lot of M&A, and IPO markets have pretty much dried up over the last few years. So it's a tough exit environment for VCs, and that means they're preserving their money to fund existing companies to make sure they can make it through. And it also means that they haven't been able to deliver great returns. And when VCs don't deliver great returns, they can't raise new funds, and a number of VCs have struggled to raise funds over the past few years. And so it's a constrained environment in funding for companies. So life has been tough. But there is some respite. Some of the VCs that had moved away from clean tech and widened their remit have actually recently made investments which look more like clean tech. And in the first half of this year, there's a lot more buzz and activity in the M&A market. But remarkably, IPOs, something that you never heard about 4 months ago. Probably every investor here right now is now thinking about IPOing one of their companies, creating a great industry for the banks, which make a lot of money from IPOs. One interesting phenomena, companies that have struggled to raise money, that are very far from commercial revenues, that are not profitable, some of those are also listing on markets in the Nordic stock exchanges and also on AIM in London. And that would suggest to me that there's a unique window of opportunity at the moment where there's a certain amount of buzz, perhaps a little bit of hype, pretty high valuations, both public and private, deals like Google and Nest, people waking up and looking around. Perhaps it's a great time to look at selling your company. How long will the window last? I'll leave it to other speakers to reveal. Where is the money going? So it's going into energy efficiency. It looks like ICT. It's very scalable, quick to market, low capex, smart home type technologies. I have a client in that space at the moment. VCs love it. Solar, I think there's probably some infrastructure money creeping into the numbers here. But also there's been consolidation in the space. People have acquired assets, consolidated assets, and are now raising money again. Energy storage is a place where consolidation is due. Advanced materials is a very hot space with applications across a whole range of sectors. One of my clients is a very interesting company in this space, touchscreen technologies for bendable smartphone displays. Canatu will be speaking immediately after this. And then water waste, recycling, these are places where there's real revenues on the ground from public infrastructure projects globally. Which sectors or which geographies are hot? Well, UK, Germany, France, Benelux, the Nordic countries. Interestingly, Italy makes a good appearance, not so much on the ICT side, but certainly in clean tech. Where are the buyers coming from? It's often assumed that the US is the great source of the big buyers. I think that's true in ICT. It's not so true in clean tech. Most of the acquisitions in Europe happen from Europe into Europe, but usually cross-border, and that's what Cartagena Capital specializes in. But North America is also pretty active, and Asia. Now let's talk about when is the right time to exit your company. When you're near the peak in the hype cycle, and there is a hype cycle, certain technologies become hot. When the space is hot, buyers start to look. There's one or two deals. There's a lot of awareness and news in the marketplace. Other people get up and start looking. And so investors like to follow, and buyers like to follow hot spaces, and then more money becomes available. If your competitors get acquired, there are going to be some disappointed buyers in the wings. Their competitors are going to wake up and start thinking about buying as well, and that's a great time to start looking around. Same again if you get approached by buyers. That means there's probably some interest in the market, and it might be worth opening up to a wider buyer universe and seeing what kind of value you can get and whether it makes sense to sell now. Another great one is when you're starting to show those revenues which prove the hockey stick projections, just the very beginning of the hockey stick, but real customer traction. The orders are beginning to come in. This is a very good time to think about selling, but for your investors, it's also a very good time to stay in. One big driver of exits is that your VCs are getting close to the end of their funds. It's actually a major driver, and that's why it's important to plan this well in advance so that you can time it properly and not when the markets are not so good. And have a look at whether buyers have a lot of cash. This is certainly true at the moment. Quite a lot of American companies have a lot of cash outside of America, and they keep it outside of America for tax reasons and often use it to buy European companies. When's the right time to fundraise? Well, if you're not quite there yet, but you can see that you can get there. Within a few years, you're confident of being able to achieve those milestones that keep giving you the uptick in valuation. You can get there with capital efficiency, using money wisely, and your investors have the patience and are willing to step up to the plate in another fundraising round, then it's well worth following it through and waiting for the right time for that acquisition so you can fundraise now. In the exit process, there's a lot of different parties who have quite different expectations and needs. The buyers are concerned about where will this acquisition fit in my organization, which business unit, who is my internal sponsor, what's the chemistry between the people, where will they fit. Buyers, particularly strategic buyers, are very process-driven, and we as advisors often help take them through those processes of the internal approvals, which can take a long time, and we support them with the business cases and help them get all the way to final approval. The shareholders are concerned about less risk and getting more money up front. They want to make sure those reps and warranties are achievable. They get as much cash as they can, and they can go back to their internal stakeholders with the valuation and say, we got a good return on this investment. The management teams are concerned about the process and how time-consuming and distracting it is to the management. And there's a number of reasons why it's great to have a good professional advisor on the board, and this is one of them, because your management team needs to keep delivering those milestones during the process in order to get the investors excited. They may also be worried about confidentiality. How many people are we shopping this around to? How do we make sure that technology doesn't leak? If they're about to become millionaires, they might be concerned about tax issues, and they'll be concerned about where will they fit in the new organization, what's the earn-out period, and things like that. It's very, very useful to have an independent professional third party like an advisor in place to help balance the needs of all these different parties, to get to a valuation that works, but also terms that work for all the parties, and to follow it through so that nobody gets upset and the deal gets done. What do you need to achieve a great exit? You need to attract the right interest. Be attractive, be ready, and be hard to get. Be attractive. Well, if you're in a hot space, that's always attractive. You've got traction. The growth is beginning to show. The projections aren't just projections. You're sure you can deliver against the milestones during the next 6 months to keep impressing the people who are doing the due diligence, and ensure you have something special underneath the kimono, a unique technology. Be ready. So the shareholders should be aligned, sure that they're ready to launch into a process, or if there's an approach, sure about what are their minimum terms and valuations and whether they're aligned and ready to sell. That really helps. If there's disalignment in the board, transactions can be quite difficult. Ensure you have sufficient cash to see you through the process. Have a professional advisor on board, somebody like Cartagena Capital. Be hard to get. It's always useful to have an alternative plan for growth, not just for selling the company, but confident that you can, if required, raise the money and turn this into a big company. Have investors who are willing to bridge and who are willing to invest more, who believe in the growth of your company. And have any good CEO is already going to be talking to potential buyers. They might be your customers, they might be your partners or suppliers, but you should always be teasing, flirting, attracting interest from potential buyers, and they're probably in your ecosystem anyway. Good, so that's about achieving great exits. Thank you very much. I'm open to questions.
Great. Do you have a question for Jay? How many exits have you been involved with?
Well, I've been in Cartagena for a couple of years, and I'd say about 7.
7? Cool. So this is Mr. Experience. Okay, any other question?
So you said you were involved in 7 exits, and do you have in your experience some exits that fell apart because of the discrepancies on the board, with conflicts between the initial shareholders and the management regarding valuation or change of control issues?
Right. So, well, very rarely you get non-exits, companies which can't exit. We've also had cases where there's a lot of interesting tension between the different parties, particularly, for example, I mean, in a fundraising, if you have financial investors and you've got strategic investors coming in, they want very different things. Financial investors want terms that allow them to exit within the next few years to an open market. Institutional investors want to have the last bid in the exit and have unique access to information, and they want a long-term play. So it's quite difficult to coordinate all of the terms, and we've been involved in very difficult negotiations. Sometimes we've had multiple parties, and somebody storms away from one party, and then they want to go back to the original party that they've already upset. Usually we try to control those communications, but it doesn't always work, so people can get upset, and we have to keep everybody sweet and bring them back into the deal, and that's what I did last year.
Okay, one more question.
Hi, it's Sylvan from ParkTech. So I just saw your statistics and they were interesting. I'm curious, is there any leniency in clean tech towards equi-hire or trade or asset deals? I would suspect it's more asset deals because there's more technology involved, but you know, what's your experience?
I mean, it depends on what level you play with. In clean tech, there's a lot of large deals on the infrastructure side. We deal more in kind of venture-backed growth companies at the smaller level. Some of those are technology acquisitions, particularly with strategic buyers and investors. You're looking at technology. Sometimes it's equi-hire, getting access to a great team. So we see all of those things.
Okay, thank you once again, Jay.
Thank you.